Welcome, everybody. My name is Chris Murphy, a partner here at DebtLink. And since my partner's name is Chris Runcie, clearly Chris's are cheap in this group. I can be affectionately referred to as Murph. Other times of the year, I'm referred to something else, and that will become clearer as the day goes on. But I want to take a couple minutes and just welcome you all here to our first DebtLink webinar series, Voices of the Arm Industry. We're very excited to welcome you. I'm going to read this because we did a lot of work to make sure this looks sharp. But we're very excited to welcome you to the first series of the webinar featuring industry leaders and members of the DebtLink community that we're calling Voices of the Arm Industry. Each month, we'll explore new topics and invite DebtLink Premier members to join us as panelists and share information and perspectives that help the ARM community. If you're not familiar with DebtLink, we built the industry's first searchable directory where businesses and creditors can search for vendors in multiple categories with various filters for free. Be sure to check out debtlink.com. Just as a side note, we're excited about this whole Voices of the Arm industry and the ability to bring additional information and give people the opportunity to ask all sorts of, from the most basic questions to the most detailed questions. So we're excited to have you here. We can't wait to see engagement and what you think. At this point, I'd like to introduce my partner, Chris Runcie. He's the brains of the organization, clearly, DebtLink co-founder. He will introduce our panelists, moderate today's discussion about the market for bad debt sales. Chris has been facilitating sales and placements of distressed consumer and commercial receivables at the Runcie Group for the last 2 decades. I know him from 25 years ago, so this is pretty soon going to see the last 3 decades. But for any of you here, most of you know Chris is one of the most relied upon assets in the debt buying industry. And so I'm very proud to have him as a partner on DebtLink. And with that, Chris, you got the ball.
Thanks, Murph. Really excited to kick off this webinar series, and especially excited about this group of industry experts and friends who have joined us today. Been wanting to do this for quite a while now at DebtLink, and it's great to finally be underway and getting such great feedback. In terms of the format for today, I'm going to briefly introduce each of our panelists, and then I'm going to ask them to provide some background on themselves, their companies, and talk a little bit about how they got into the positions that they're in today. Just a hint, there's a few cool stories along the way and some common themes, so stand by. Following that, I'm going to ask each panelist to address a distinct segment of the bad debt market. Although there are some companies that cover all 3 market segments we're going to talk about today, many of them are specialists in one or the other for reasons you'll learn more about later. Adam is going to lead the discussion in the consumer debt markets. Scott is going to lead the discussion for the commercial bad debt markets, and Rui is going to lead the discussion for the bankruptcy bad debt markets. Following that, we'll open the floor up to any questions from you on anything you're curious about, and we're ready to dive in. So again, we've got 3 industry experts joining us today. Rui Pinto Cardoso, President and CEO of Quantum 3 Group, and I want to call out Rui specifically because he got a frantic text from me last night at about 8 o'clock Eastern time when Jonathan Coop, our original BK panelist, informed me that he was down and out with the flu and wouldn't be able to join us. So Rui, special thanks to you for making yourself available today.
My pleasure, Chris.
I have Scott Ogden, recently minted president of SCJ Commercial Financial Services. Very proud to have you with us today, Scott. Thank you.
Thanks, Chris.
And Adam Doverstein, managing partner of the Doverstein Law Firm in Wisconsin. Thank you, Adam.
Thanks, Chris. It's good to be here.
All right, so with that,
Chris, we didn't call out our sponsor for today's webinar. I screwed up, should have said that. I'll let you.
Absolutely. Special thanks to LexisNexis for sponsoring today's webinar. Adam, I'm going to pick on you first and put you in the hot seat. You have a unique background. You're a very busy guy. It wasn't until I wrote this all down that I realized how many different things you actually have going on. But you are the managing partner of a law firm with your brother. You're also the owner of a collection agency and you own and manage a debt purchasing business. And in what spare time you have available, you're also a head varsity baseball coach at a high school, a position that you've held for more than 25 years. So love to just hear a little bit more about your family story. It's pretty unique, and I've heard you tell it before, but I'd love for you to share that with our audience.
Yeah, absolutely. And glad to be here, Chris. You've been a great resource for our companies and become a great friend over the years. So it's a privilege to be on with you guys today. Yeah, I've been working in the collection industry for 25 years. I got my start. My parents started Collection Associates 43 years ago now in 1982. My dad was a teacher. He taught high school government history and psychology, was his full-time profession. And in the early years of being a teacher, he was the youngest teacher on his staff at his school. And for a few years, as enrollments were declining, he got some layoff notices and was looking for something to do in the summers. And one summer, my mom's grandfather owned a welding shop, and he collected past due accounts for him that summer, went out and collected money due from masons for steel beams and things like that. Found that he had a knack for it. He never got laid off from teaching, so it kind of became a side business for him. That my parents ran for the first 15 or 20 years as my brother and I were growing up. And then my start, I finished my undergraduate work in the summer of 2000, got married that June, and I had planned to teach and coach. I played college baseball. That was my passion. And while I was looking for a teaching position that summer, for the first time ever, really, I worked for my parents a little bit. My dad told me he wouldn't pay me anything. I'd have to earn whatever I got. So I went out. I had to bring in my own past due accounts. I knocked on doors, physically knocked on doors, asked people if anybody owed them money. Had a knack for that myself and hadn't found a teaching job by the 4th of July weekend. And so with my wife and family encouraging me, I decided to apply to law school kind of at the last minute, got into Marquette and went to school part-time at Marquette and decided to work full-time in the business. And so from there, a number of years later, my brother and I started the law firm, and we started to buy some of our own paper in 2006, and have kind of grown from that point forward to the point that we do now manage different verticals in the market and own different verticals in the market. So
That's awesome. That's a great story. Thank you for sharing it.
of course.
All right, Mr. Ogden, you're in the hot seat. And I think there's a baseball theme in your backstory too. Isn't that correct?
Yeah, my story is not nearly as exciting as as Adam's, but I started out in the collection business 10 years ago. I ran into an old baseball coach. I was working at the YMCA, and I was in college just trying to get by. And he said, "Hey, just come work for me. I got a job for you. I'll have you push paper. Don't worry about it." And I show up the first day, and he's like, "Hey, here's a phone. You're actually gonna work collections." So 10 years ago, I think he tricked me because he knew I wouldn't do it either way. So that was Mike. That's the former SCJ president. So he kind of threw me into the fire there. So I started in collections, worked my way up through that, got into the credit division and all of that side. That was for American Finance, still on subprime consumer collections. A couple of years ago, we had all gotten together and we decided, hey, we're pretty good at this collection stuff. We could look to start a debt buying company, see where it kind of goes. We acquired a commercial collection agency. Figured out how that commercial side worked and kind of just grew that out. Over the last couple of years, we kind of developed it into a little bit of a commercial powerhouse on the buying side, and have been running with it. So it's been eventful. It's been exciting. It's not something I ever thought I would be into, but here we go. I guess baseball leads us to collections is kind of the root of all this. So
Really cool. Really cool. Thank you for sharing that, Scott. That's awesome. And congratulations again on the president position.
Thanks.
All right. Rui, you're up. And again, thank you so much for agreeing to do this at the last minute. I'm hoping Jonathan is at least watching us today, and I hope that he's feeling better. But Rui, give us a little bit of background on yourself, your company, and if there's any baseball related themes, please bring those into play as well.
Thank you, Chris. Although I must say that normally I get a little bit more than 18 hours advance notice for a panel like this, but definitely a pleasure being able to assist in here. No baseball stories, but interesting fact, when I was 6 years old, I had, and in thinking about how I got into bankruptcies, when I was 6 years old, I got an epiphany, and I decided that I would want to be a bankruptcy expert one day. No, I'm kidding. I'm kidding. Like probably 90% of the people that are watching this webinar, I ended up in this industry pure by coincidence, by chance, and my experience is that most people are like that. So I was a professor at the university in Florida. Then I worked for a bank. That's when I got exposed to the collections recovery environment, and later I was hired by a company that is no longer in existence, but did the same thing that my company does. The company was called Beeline. Some of the folks probably remember that name, and I was president there for about 10 years. And in 2010, I decided with some business partners to basically launch Quantum 3 Group. The company is rather unique in the fact that we don't do anything else but bankruptcies. So we are not experts on any of the areas that the other panelists are going to cover. And we just try to be good at one thing. It's really hard to be good at many things. So we stay within the bankruptcy arena. And the company has been in existence since 2010, and still doing just bankruptcies. In my spare time, no baseball stories. I am nuts about being out on the water, mostly salt water, boating, fishing, diving. That's my thing on the free time.
Awesome. That's awesome. Thank you for sharing. All right. So with that, we're going to dig into the topic of the day, which is bad debt sales, the bad debt market in 2025. The practice of buying and selling bad debt has been around for more than 30 years now. It's kind of hard to believe. And today, sellers come in all shapes and sizes. That includes banks, credit unions, auto and equipment finance companies, fintechs, rent-to-own companies, lease-to-own companies, B2B lenders, and more. Rising delinquency, charge-off, and bankruptcy rates globally are leading to more and more opportunities for companies in the space. What's really unique about right now, and I think it's different than at any time in the past, is the abundance of new technologies and analytical resources that are giving debt purchasers enhanced power, insight, and precision to refine their collection strategies, lower the cost to collect, and improve recovery rates. I don't know how many of you follow a company called Market US, but a couple of weeks ago, I posted a report that I found through LinkedIn talking just about the size of the overall market. And some of the statistics are really staggering. And I want to share some of them with you just before we dive into our specific subjects. It's expected that the global debt collection market will exceed $40 billion by 2033. Up from $30 billion in 2023. That's a compounded annual growth rate of just over 3%. And the United States represents more than 40% of that market. Collection agencies and debt buyers obviously play a crucial role in ensuring that businesses receive their owed funds, while also providing debtors with opportunities to clear their financial obligations. So with that, we want to talk about the three largest segments of the bad debt market. There are lots of smaller niche markets within each of these, but we thought for our first webinar, it would make sense to first talk about the consumer charge-off market, and then the commercial charge-off market, and then the market for BK accounts. And Adam, I'm going to put you in the hot seat first and ask you to talk about the consumer charge-off market. And I know that your businesses cover you touch all three of these different market segments, but I thought what we do first is focus on the consumer charge-off market. And I want to just mention that historically, credit card issuers were the largest sellers of bad debt. But in today's market, and Adam, you know this well, there are sellers of all shapes and sizes. And what's different about these current sellers from the past credit card issuers is that credit cards were fairly homogenous, and a lot of them looked and felt and behaved similarly, but with the variety of companies that are selling now, it's a very, very different time.
Yeah, absolutely. And you touched on this a little bit, Chris, but when I think back to when we first started buying paper, I bought my first portfolio in 2006. And then by '08, we really started to buy a little bit more. It's just a totally different market. And some of it is, you mentioned the market's a little over 30 years old. I mean, the debt purchasing market really started in the late '80s with the savings and loan crisis, and then more so in the '90s. But um, that period from '06 to 2010 was a tumultuous period. And I think back to, those were a lot of my first RMAI conferences and really getting involved in this part of the industry. And everybody was leaving in terms of the smaller debt buyers, right? Everybody I talked to said, you can't do this. The small debt buyer is not going to exist anymore. And the reasons were that, number one, the big banks were under so much pressure, both from a PR standpoint and a regulatory standpoint. You had the Dodd-Frank Act passed, and then the CFPBs formed. And so many of those large banks left the market and for a period of time. And that was the market. If you were a small state debt buyer, like a lot of our people who are listening into this webinar today, you bought credit card debt that was retraded, that originated at one of the big banks, right? And that was leaving. The best thing that happened, though, during that time period is that the market became much broader. If you were going to survive and stick around, you had to find other asset classes. And at that point, there wasn't much commercial paper, MCA paper. There wasn't, fintech didn't exist in 2006. And so you had all these things going on. But at the end of the day, you fast forward to where we are now, the market's much more seasoned, much more established, and there are opportunities for people who want to get involved to do so.
Yeah, couldn't agree with you more. What, as you sort of plan for 2025 and maybe compare it to post-pandemic years, 2020, 2021, 2022, what can you tell us about current market conditions, especially if you're someone who's thinking about getting into this market as either a buyer or the seller for the first time?
Yeah, I think the market's fairly stable. I mean, I don't know that I want to comment too much on pricing exactly, right, for various reasons.
Sure.
But at the end of the day, whether you're a large buyer, a small buyer, a large credit grantor that wants to sell, or a small one, there are opportunities to be able to trade paper, and you have to find something that works for you. And we're certainly finding plenty of opportunities if you're hustling, if you're working at it.
Yeah. So that's actually a great point. So, and that's a good lead into the next question. Obviously, you're well established. You've been in the space for a while, but for someone who's just dipping their toe in the water, maybe they've not bought a portfolio yet and are thinking about it, or they've bought one or two and they've been, sort of mixed experiences. What can you suggest in terms of sourcing opportunities? What's worked for you?
Yeah, well, here's what I'd say to the smaller debt buyer that's thinking about this, or maybe just starting. To me, the number one most important thing is you've got to be good at servicing. And so if you've got a small law firm or a small agency and you're really good at what you do, I think buying some of your own paper is a great idea. And then the key becomes, find things that are similar to what you've worked before so that you can do a good job on it. So, and again, that's going to look different for everybody based on what state or states you're in, what your agency works. But you've got to be good at the servicing piece. And then the other thing I'd say is, you've got to be aggressive in terms of talking to people. You have to take calls, you have to make calls, you have to inquire. And we're all busy. So, obviously you want to be polite and respectful, but to me, being direct is a key, right? Tell somebody what you're interested in, or how you think you can help them, get it out there. If it's a fit and the dialogue's going to go further, great. If it's not a fit, everybody can move on. To me, the relationships are built over time once you start doing business with somebody. And so I think that's a second key that I'd say.
Yep. Couldn't agree more. You brought up another point that actually I wanted to go back to. There are two distinct types of buyers. That there's some hybrid buyers, but there are those who they're what I call passive buyers. So they don't have any internal servicing capabilities. They rely on a network of agencies and law firms. And then there are direct buyers. And then there are companies that are sort of hybrids. And from what I know about your business, you're sort of hybrid. You do some internal work, you do some outsourcing. For someone who's a passive debt buyer who doesn't have those internal resources, do you have any suggestions for finding ways to be successful? Because that's a tough, as I look at it and think about it, that's a much tougher path to go down, but it gives you a lot more flexibility.
Yeah, I mean, you hit on a key thing there. You know, we do both, right? So when I started the first portfolio we bought it. It was a tiny Wisconsin portfolio, which is my home state. We bought it, we placed it with our agency briefly, and then we sent the accounts to my law firm, which was headquartered in Wisconsin. So that was the way we started, and that's the way a lot of small debt buyers get their start or operate. And now our law firm covers 5 states, and the agency's a little bit bigger, but probably the hardest thing that I've done in the 25 years I've been in the industry has been building our legal network, finding the right law firm partners, finding people who can do that sort of job on the paper that you place. And it's got to be a fit. You've got to be important to them. Everybody's got to be comfortable with the way it works. And so that is a challenge. I think a lot of the small debt buyers get their start. And that's why I talked about being good at servicing, because they have a small agency, they have a small law firm, and it's a way to add another piece to their business. As you get bigger, finding the right partners that are good at servicing and that'll do your work, whether it's agency or legal, is equally important.
Yeah. And I think one of the biggest challenges for virtually every debt buyer out there is having a steady supply of inventory, right? Because nothing's going to turn off a potential agency or law firm partner quicker than a very lumpy placement pattern where you're getting no accounts one month and maybe 200 the next month, and then nothing, and then 1,000, and then nothing for a while. So that's a real challenge if you're trying to build up in this business.
Yeah, one of many challenges, right? That's a challenge, and just finding a firm that's comfortable with the paper that you're buying and the media you're supplying and the format that it comes in, and all of those things. And to me, like, when you interview a prospective law firm or agency, you got to just pay attention, because you're going to get a pretty clear sense early on of whether your business is important to them. And I would suggest not trying to force it. If they're not interested or hungry for the work, is what I like to say, it's probably not going to work out over time.
Yeah. But based on some of the industry statistics that I've researched, there's upwards of 2,000 collection agencies in the U.S. right now, right? So there's definitely plenty of prospective partners out there. You just, as you said, you got to do the legwork and spend the time to connect with them.
Absolutely.
Yeah. Okay. So we actually have a couple of creditors who are with us today. I guess if we could step back a few steps, what do you think from your perspective as a buyer and in your experience, why does it make sense for a creditor to sell a portfolio rather than place it? I mean, I know there's a couple of obvious answers there, but I'd love to hear some of your take on what motivates some creditors and why it's the right solution.
Yeah, I think that's a great question. And I think, the vast majority of large creditors do sell their inventory at some point in the process. And whether they sell it freshly charged off or do something first, usually that's a part of the strategy. I mean, the reason is that it takes resources to oversee the collection of those past due accounts, right? You've got to hire collection agencies, law firms. You've got to manage those people. You've undoubtedly got auditing requirements. You've got to, even the simple things like posting remits every month, every week, whenever they come in, and answering questions and signing affidavits and appearing as a witness if you're doing litigation, and all those things, right? Those are real costs. So if you can sell that portfolio early in the process at a fair rate, that, the time value of money obviously comes into the equation. But if you can monetize it early on and be done with it and find the right partner to do that with, because people sometimes, when they're new to this, they look at a debt sale as just a purely transactional thing. And it really isn't. Even if it's a single sale, you got to be comfortable on both sides that the parties are going to deliver on what their obligations are, and want to be fair to one another, because you can spend all the time you want on a purchase and sale agreement, but there are things that come up that nobody anticipates. And so how do you treat people? How do you act in those circumstances? How do you work through it? And so I think for lenders that find those kind of partners, it's a win-win.
Yep. And you made another point too that I want to go back to, and that's that a lot of folks, when they're thinking about the decision to sell, they don't always think about the internal costs that are involved, right? They're
Absolutely.
simply looking at the, you know, the number, but they're not factoring in all the other overhead that goes into that, and they need to.
Yep.
Yeah.
For sure.
Yeah.
Yep. You can get sued too, right? I mean, a lender, if they decide to collect on there, you get sued, you have those costs, defense costs. And not that things don't happen sometimes when you've sold an account, depending on what the issue is and who's responsible. But it works, and it's a way to offload something. It's kind of like outsourcing, right? Our business is, if you're in the servicing business, you're looking for segments of your work that you can outsource, and it's a way to be more efficient and economical.
No, that's great. That's great. All right. So just before we close out this, and we'll circle back on it too, but any resources or tools in particular that have sort of helped you that could be of use to our audience today?
Yeah, I mean, I think, when I made some notes here and I was thinking about it, I kind of jumped to this right away. But the tool as a debt buyer that's important is the servicing piece, is whether you're doing it yourself or outsourcing it, having the right methodology to be able to liquidate the accounts. And then you hit on it earlier, like analytics has changed rapidly. So the ability to find the right technologies to be able to evaluate portfolios, and you start with the things that you own already. And then you take that data and you're able to apply it to things you're looking at as you grow in the industry. But there's a lot out there that will help you figure out what makes sense for you.
That's awesome. That's awesome. Thank you. All right, Mr. Ogden, we're going to put you in the hot seat now, and we're going to ask you to talk about the commercial charge-off market a bit. So, as Adam mentioned,
I hate to interrupt real quick. At some point, I'd love to do a little poll to find out who's on here and has anybody. So,
oh, I'm sorry. I think I forgot to do that. I got so into the conversation. Bear with me a moment, and I'm going to launch the poll now. My apologies, Scott. Hang on, stand by.
No, you're good. No worries.
Adam, I love I love listening to what you were talking about. It brings back. I mean, I way back. I mean, I'm by far the oldest guy on this panel for sure. But I remember getting into debt buying back in the early 2000s as well. And I had a very unique model that I went to. But your comment about analytics, I kind of dubbed in. I know this is a shameless plug for our sponsor, LexisNexis, but back when I first started in the industry in the late 80s, I remember doing a special project with Lexis, the old Lexis, to really start to identify basic collection analytics that they were back then really starting. So they've been great from my world. They really were one of my early things I worked with. So I thought that was right on point on tools to take advantage of what you have in house, and then looking for strategic service partners. And again, while we're getting ready to, this poll just kicked in, and it's going to ask a couple questions. So we'd love, anybody, the 70 some odd folks on the webinar right now, I'd love you to click on the answer, because that's going to.
They're actually coming. So the results are coming in now. I'll give it another 10, 15 seconds, and then we'll close that out and move on.
That's awesome. So during this little commercial break, I would say one of the things that I'm excited about is DebtLink. And so for any of you that are on the webinar that are looking for strategic service partners, whether it's skip tracing, data analytics, law firms like Doberstein or others to help you with your collections, you're looking for a strategic partner, or you're looking for an agency to assist you, DebtLink step one, you go there, it's free. You can click on the category that you're looking for, or you can go to all categories and search those. It's in essence like a 24-hour a day, 365 trade show booth, where you can go do research on some partners and then direct connect with them. When you work through DebtLink and you decide to connect with a particular partner, it is a private connection. Your information is not distributed. We're not an Angie's List for any of you who have ever done that. Angie's a great company. We're not that. And so everything that's done within DebtLink is private. And it's a way for you to really connect with some great people like you're seeing on our panel today, and find some other great solutions when you're looking to figure out how best to move forward. So,
awesome.
All right, Chris, that was my commercial.
Thank you. I've got some results. So it's interesting. 38% of our responders have never purchased debt, but are interested in doing so in 2025. 56% of our respondents have said that they've purchased, but are looking for more information. And 5% of our respondents replied that they're debt sellers or prospective debt sellers. So appreciate that information.
With that, we're on with Scott.
All right, Scott, you're up. So I want to talk about the commercial charge-off market. Couple of different types of companies that sell. We know equipment finance companies, merchant cash advance companies, B2B lenders, fintechs. Tell us a little bit more about what makes because you have experience in both markets. What makes commercial a little bit different than consumer?
Yeah, sure. It's going to be tough to follow Adam. I'm pretty much going to regurgitate a lot of what he just said because everything I had written down is pretty much what he just went through. So he did a good job of kind of hitting that on the head there. The biggest thing with the commercial and consumer space is the volume. With the consumer side, there's tons of it. I was looking at a report from 2023, and it said that the average charge-off rate for a company on consumer loans was 6%. On the commercial side, it was 0.5%.
Wow.
And that really kind of dropped off, post-COVID and all that stuff. So there's a couple of things. There's obviously tons of consumer lenders. There's a lot more out there. The commercial side, there's not nearly as much. And with that, there's stronger underwriting because the deal size are larger.
Yeah.
Businesses are a little bit more sustainable than kind of your average consumer. So the condition wise, I would say it's significantly less paper that kind of floats around than the consumer side. I mean, the consumer, you have, the auto deficiencies throughout the world, the medical debt,
Right.
student loan debt, just those three factors right there kind of make up more than you'll ever see in the commercial space. But the commercial looks like it's kind of more evolving. I think it's a little bit behind on the consumer buying or selling side. But, over the last couple of years, we've kind of seen a ramp up of it,
Yeah.
especially when everybody's kind of dealing with those post-COVID,
Yeah.
when everybody approved everybody paid their bills, and now all of a sudden they're kind of seeing the downfall of that.
Yeah.
I think this next year is kind of going to lead into seeing those numbers really start to trend on the charge-offs, and that'll in turn lead to people being like, okay, it's time for us to sell.
Yeah, I was able to run down some stats in preparation for the webinar today, and I, based on what information I could find, it looked like commercial bad debt sales were up about 20% over the previous year in 2024 compared to 2023.
Yeah.
So we've had some experience brokering a number of commercial portfolios. Most have been for equipment finance companies, and there's always this issue of whether or not there's a personal guarantor. What can you just, for those who maybe not know as much about commercial charge-offs, tell us why that's important and how you sort of factor that into the equation?
Yeah, we're big on purchasing accounts with personal guarantors. It's hard to see a lot of these mom and pop shops. They don't keep track of what's going on with their business, if they're reporting to Secretary of State or if they're doing their kind of file, their formal dissolution paperwork or anything. So you never really know if they're in business or not. So you could buy a portfolio with them. Somebody could sell it and say, hey, here's 100 accounts. They're all in business. They don't have personal guarantors. There's no way for you to do a real good scrub to be able to see. We try to get as much information as we can, and we utilize resources like LexisNexis or a couple of the other, platforms that are on that link, and try to do a quick scrub of that to see what we can get.
Yep.
The personal guarantor for us is kind of like our bread and butter, because that's who, at the end of the day, you're going to have to kind of hold them accountable for everything. They're the ones who took out the loan, really. So if the business goes upside down, I mean, a lot of businesses don't make it in this world, so you got to have somebody to be able to go after, because you can sue a business that's not in there anymore and get a judgment, but then you just have a piece of paper and you don't have any way to enforce it.
Yeah.
So that's why we're pretty heavy on the personal guarantor.
Yeah. Yep. No, that makes a lot of sense. Thank you. And maybe we didn't spend as much time talking about what sort of factors beyond the obvious. Well, there's nothing that's too obvious, but tell us a little bit about what goes into pricing considerations. What are you looking at? What's most important versus less important to you as you evaluate portfolios?
Yeah, we're heavy in the equipment side. For us, it's evaluating equipment that's still out there.
Okay.
A lot of the consumer contracts say it's a credit card debt or, it's medical debt and stuff. There's nothing to really kind of use as leverage to go after the customer other than place it on their credit report. We try to pursue equipment finance contracts, and with those, we hope that the equipment's still out there. A lot of times, lenders are very good at recovering and disposing of the equipment, so then you're kind of just chasing deficiency balances. But
which there's a market for, but albeit at a different price.
Yeah, absolutely. Yeah. So that kind of plays a big factor into it. You know, if there's collateral that can secure it, we just felt like there's a little more leverage to go after people on the commercial side if you can have something that's kind of secured with it. And sometimes that's just with the UCC on there too. You know, if you can kind of hold a UCC over a successful business and take that route, that works too. You know, we factored that in. Personal guarantor comes into a big play on it, seeing how they are. And then, I mean, our biggest kind of pricing factor is we realize that no creditor or lender has the same internal collection process, charge-off process, anything. A lot of lenders like to look at charge-off dates and they say, hey, you know, it's, you know, only 6 months since they charge it off, but they might charge off at 1 year, 2 years, 3 years since last payment date. I would say, you know, if you're kind of looking to get into this, you should focus on the last payment date more than the charge-off date. It's kind of one of our, I guess, secrets or trade, you know, kind of things that we look at to make sure, because I came from the credit space, you know, we didn't charge off everything like we said we did. We did a good job of it, but things vary. There's so many different factors into it. Last customer payment date is very crucial in kind of looking at everything.
Yep. And obviously you're looking at past treatment history. You're looking at the quality of the information that you're provided, both the electronic data and the supporting media. I know we didn't really talk about that much with Adam, but media is hugely important.
Yeah, I mean, we always request sample sizes up front. You know, we're very big on compliance. We got to make sure that we can handle the account correct. Some lenders don't do things the best way. Most of them are pretty buttoned up, but some of them, you know, they kind of, you know, slide under the radar. So we always review everything to the fullest extent, make sure that, you know, if we're bringing something in-house, it's something that we feel comfortable going in front of a judge and saying, hey, we didn't originate this, but we feel confident in what we have here. So, you know, reviewing sample packets, working with people, getting seller survey. You know, we're pretty agnostic when it comes to outsourcing deals and where we get our resources from. We use brokers like Runcie Group, DebtLink, a couple others. We, you know, do networking through conferences and everything else. We always put together a little seller survey at least so we can get general information on the accounts and then request some sample docs. That way we can just make sure that we're buttoned up on what.
That's great. That's
we're
great.
doing.
All right. Appreciate that, Scott. That was really, really helpful. Rui, actually, before we go to Rui, I want to again thank Lexus, and they shared this slide, and so I've been asked to share it with you, but we want to just use it to, there's a lot here to unpack, but I think kind of the highlights, and we'll dig into this a little bit further, is that bankruptcy filings are on the rise. In October 2024, they reached 55,000 filings in a single month, which is the highest single month of filings for bankruptcy since the pandemic began in 2020. So thank you, Lexus, for this slide. Rui, I'm going to ask you to now talk about the bankruptcy market. And bankruptcies are like probate and legal and out-of-stat. It's highly specialized, and it's an area when we're talking to creditors and we're bringing a portfolio to market. Frankly, it's something that a lot of folks, I think, missed the boat on. And I'm hoping you can maybe shed a little bit of light and tell us what's important about BKs. What do we need to know if we're buying or if we're selling?
1 second before you go, Rui. And as we get into bankruptcy, I want to encourage everybody who's on the webinar, feel free to submit. We're monitoring for questions. So as you hear these panelists discuss topics, or you're looking through the deck as we click through, if you have a question that pops in your mind, go ahead and type it in or raise your hand, and we will, that way we can get them out to the, we're going to address them later in the webinar, but feel free to jump in there and ask questions along the way. We're monitoring it. So with that, sorry to interrupt, Chris.
No, thanks, Mark.
You got it.
Thank you, Chris. And Chris, I would ask you just to go back to the slide that LexisNexis provided us, so that I can point out a couple of things that are important here. So the red line is 2020, and you see that huge drop there in March 2020 when COVID hit. And really, if you look at the subsequent years, 21, the light blue, 2022, the orange, you see a trend of bankruptcies going down.
Yes.
But starting in 2023, you see the bankruptcies going up. So you see the dark blue line is above that orange, and the 2024, which is the yellow, is above all the others before, including 2020 post-COVID. Also, as you can see, we are not anywhere near the volumes that were pre-COVID, which is that beginning of the red line. So the yellow line is still low, but it's important to notice, and you mentioned that bankruptcies are on the rise and very significantly. They increased about 15% from 2023 to 2024, and the expectation is that they will continue to increase. I mentioned this because for a few years, people could afford to not really think a lot about the bankruptcies.
Yes.
But now, as the bankruptcy volumes go up, it's something that you should take in consideration when looking for opportunities to monetize your entire portfolio.
Yep. No,
Um,
that's very helpful.
and-
One quick question. Can you maybe comment on the spike in 2020? What drove
Yeah.
that?
Yeah, and what you're not seeing there is prior years. So there's really not, that's not an uncommon spike. There's some seasonality,
Got it.
around the March timeframe and later in the year. But the bankruptcies were trending around that 70,000 a month prior to that. So it's really not a spike. That was just the normal level.
Understood. Yep. Thank you. Thank you.
Where they were. Yeah, absolutely. As to your other question, what makes bankruptcies unique? So there's a few points worth mentioning. The recovery on bankruptcy accounts required a very specialized process. There is typically no interaction with the debtor, which, by the way, in today's regulatory environment, that's a great thing that we don't have to interact with the debtor. So it's a process that it's mostly administrative in nature. And one of the most important aspects is that it's an asset that has a short expiration date when it comes to preserving its value. So while on charge-off accounts, you can afford to not do anything with the accounts. I mean, obviously not advisable, but you could put them on a shelf for a year and go back and start collecting. On the bankruptcy side, if you don't take certain steps quickly, the accounts are become worthless. So there is, as a creditor, you only have approximately 70 days, 70,
Yes.
from the date that they filed bankruptcy to file a claim with the court, what's called a proof of claim, or POC for short. And that will ensure that you will be part of any distribution that the estate may have. And you have 70 days to do that. And if a POC is not filed in those 70 days, and we're talking about unsecured accounts, which is most of the audience here, the accounts become virtually worthless. So that's a big difference between this asset class and the others, is this time factor. I think it's probably, in terms of talking about the uniqueness, it might be worth mentioning some misconceptions. And these are some questions that I get when I participate in panels. Questions like, is it risky to sell and outsource BKs? There's this concept that BK accounts are something that you want to stay away with, not even touch with a 10-foot pole, which is true from a collection standpoint. But if you sell or outsource to the right entity, someone that specializes in this area, it's actually a low-risk proposition, because us as servicers or buyers, remember, we don't interact with the debtors. And if you think about it, most of the problems start there with some sort of interaction that didn't go well. The other question that I get a lot of times is, hey, you only have 70 days. So even if I sell or outsource, does that mean that I have to have an internal process to file the POCs before selling? The answer is no. Again, working with your partner, part of what they do, whether buyer or seller, they can file the proof of claims for you, so you really don't have to do anything. And the last question that I get is, are Chapter 7s completely worthless? or another way of asking the question, you do what? You buy Chapter 7s? What's the catch? And I can get a little bit into the differences between Chapter 7s and 13s if you
Please,
think
yeah,
it might
I think that'd be great.
Yeah, I'm not going to get into much into the weeds, obviously, but major two chapter of bankruptcy in the consumer space, Chapter 13s and 7s. The 13 is essentially a reorganization where the debtor will repay part of its unsecured consumer obligation, and it's on a plan that it's either 3 years or 5 years. Most of the plans are 5-year repayment plans. And Chapter 13 is really where most of the value of your bankruptcies resides, by far. The Chapter 7 is essentially a liquidation, and the debtor gets a discharge of his or her unsecured obligations very quickly. It's a fast-track process, about 6, 7, 8 months. However, there are cases where the debtor has assets in excess of what he may exempt in the bankruptcy filing, and those excess assets, in those cases, the trustee will forfeit on those assets, whether repossessing a car, foreclosing on a piece of land, and the trustee will liquidate them and make a distribution to the creditors that file a proof of claim. That's why Chapter 7s are not worthless. How often does this happen? Very, very seldomly, and the price of the Chapter 7s reflect that.
Yep. That's wonderful. Are you, given what you said, are you sort of agnostic about the asset class that this comes from? I understand that age is important and you have to file the POC, but is a credit card any different from your perspective than an auto deficiency?
We work all types of accounts. We work, secured accounts and unsecured accounts. All of them have their value. Obviously, secured accounts are more valuable than unsecured accounts because they are treated preferentially in a bankruptcy process. But there's a market for all kinds of secured and unsecured debt. So if you are a creditor, if you are a debt buyer, that now some of the accounts went into bankruptcy, there's value. Whatever the portfolio is, there is value to it. And although there may not be value on your existing portfolio because claims were not filed and so on, you always have the opportunity to start going forward and partner with someone that can extract the value on those bankruptcies.
That's terrific. And your company works with both credit issuers and with debt buyers.
Yes, and interestingly, the split is probably about 50-50. So we have a lot of customers that are debt buyers that, like Scott and Adam, that part of their accounts will file bankruptcy. And that's where we come in as part of a strategy to maximize their recoveries. Like they probably have a solution for debt settlement accounts and a solution for probate accounts. We come in with a solution for their bankruptcy subset.
Wonderful. Yeah, that's really helpful. Thank you. And again, thanks for subbing in at the last minute. You did a great job and really appreciate it.
Yeah, and Chris, if I may say, there's probably 3 things that I would like to leave with this audience with regards to bankruptcy. How can you maximize the value of your bankruptcies? There's 3 relatively simple tasks that will maximize the value of your bankruptcy. One is timely identification of the bankruptcies. So you want to know about the guy filing bankruptcy as soon as possible. For that, you can use a scrubbing or monitoring process like LexisNexis, our sponsor, has. And that's extremely important because remember, we are on a time crunch, 70 days. So the faster you know about it, the better. Second step is to appropriate coding the account in your system. You want to make sure that you stop collections, that you stop all communications, you recall from agencies so that you don't get in trouble, and you tag the account in a way that you can then pull a file to place those accounts. And last but not least, what I mentioned, it's the timely filing of that proof of claim. You have 70 days, whether you decide to outsource as the third party, whether sell, do in-house, make sure that you do something. And that's the only way that you can preserve the value on the bankruptcies.
Yep, that's terrific. Thank you. All right, I think with that,
Sorry, Chris, we have about seven or eight questions that have come in.
awesome.
Analysts have been talking that we've been calculating, so I'll read them out if that works for you, Chris.
Yeah, good. Shoot them, do one at a time. We'll get as many in as we can.
Yeah, I'll read them out, and whoever you guys as the pros answer it. The first one was less of a question and more of a shout out. Adam, you got a thumbs up and outstanding, so there you go.
Thank you.
Anyway, another question we got is, what if someone is selling a geographically broad, even nationwide portfolio? Should I buy the whole portfolio, or can I ask for it to be broken up into only the states where I operate?
Adam, I know you're chomping at the bit for that one. Go ahead.
Well, that's $1 million question. I mean, I say that because it's something at a point in my company's evolution that we really wrestled with, right? I mean, we were one of the reasons we survived that time period in the late 2000s was a willingness to expand our geographic footprint and the number of asset classes we were buying, so as to become important to those sellers or resellers that were still trading during that time period. And it's something that I think a lot of people didn't want to do or weren't willing to do. But it really depends on, what you have in terms of resources and capital to be able to get the licensing that you need and have the team in place to be able to do that. So, I guess I'm just reading between the lines a little bit on the question. I would say if you're a one state or a couple state shop and you'd like to get inventory in those states, it never hurts to make an offer for your states and to put a premium on it. And sometimes sellers, present company included, chop things up and resell them on a state or regional level. So I think targeting what's most important or most valuable to you is probably a good idea. But if you're going to get bigger and try to buy larger portfolios and then retrade pieces or begin to work in other geographic markets, there's a lot to kind of figure out in terms of licensing and infrastructure.
Yeah, that's great. Scott or Rui, anything to add?
Yeah, I mean, I agree with Adam on that. We started out the same way. We were, a smaller company. We were just a commercial collection agency. When we started buying, we kind of really honed in on what was going to be our niche. And, we knew it was going to be commercial space, but there's a lot of different things. So we found a geographical area where we knew, all right, here's 5 or 6 states that we want to try this out on. Yeah. Let's buy those and kind of keep it small. The biggest thing too was helping us kind of figure out the process. I don't know if it's possibly your first time buying, but the first deal doesn't go as smooth as you hope it does. The first 5 don't. So a lot of it is dialing down the process too. It's a lot easier to do it on a smaller scale. You might even pay a little bit more of a premium, like Adam said, because you're selecting specific states. But with that comes the education of figuring out your process, getting in all your procedures in place, your recovery process, like Adam said before. You got to find out the best states. Don't just buy it, because there's an opportunity there. Make sure it's going to be something that makes sense, because if you don't have the right recovery structure in place, you're just going to be throwing money at something. So we were very selective in our first couple deals until we really got a good process. We kept it state specific, regional specific, until we felt like we had it buttoned up, because we wanted to make sure that our process was in tune. So when we went to the seller, we were confident in what we were, kind of delivering to them.
Yeah, smart, really smart.
All right, next question I have. Are we seeing less hedge fund style funding in the commercial charge-off arena?
Yeah, so what I experienced over, kind of the post-COVID was there was a lot of consumer stuff that had been bogged down. There were a couple new hedge fund guys that kind of had trickled in from the previous consumer side into the commercial side. The hedge funds come and go. They're kind of very sporadic in how they do things. We've seen at times an influx of them where there's been a couple of them who are just kind of willing to go in and spend some high dollar, get some stuff, and then they kind of fizzle out over 6 months. Who knows? Those guys are, kind of in a league of their own, and they're, they have something that works for them. That's for sure. But we see them come in, and when one comes in, there's usually a couple that follow. So there must be some sort of trend that they follow. Right now, we're seeing a little bit, but not like we saw kind of, immediately post-COVID. But again, it's cycles and trends. I imagine they're going to kind of, jump in. And when they do, it usually drives up kind of rates and everything else because they got a little bit more money to play with. And that side of it. But I feel like it's stable right now. It's not like they've kind of, saturated the market or anything.
Yep, that's great. Thank you. What else do you have, Murph?
We have one. Do we have access to a copy of the slide deck? Answer yes.
Yep. If you're a registered attendee, we will email out a copy of the deck and contact information for LexisNexis, our sponsor, and for each of our panelists.
Let me see here. If you have a Chapter 7 BK notice and there are no assets, there really is no reason to file a POC until the trustee says there are assets. Is that correct?
Generally speaking, yes. I mean, obviously, we would have to get more information. Is it secured? Is it unsecured? But generally speaking, that's correct. And by the way, the fact that it's a Chapter 7 asset case doesn't mean that there will be assets for distribution. It just means that there are non-exempt assets, but the trustee still needs to get a hold of those and liquidate them. The rule of thumb is on a Chapter 7, we only file a POC when the trustee issues a notice to file a POC. So unlike the Chapter 13s, you have 70 days from the bankruptcy filing. On a Chapter 7, you can wait until the trustee issues a notice to file the proof of claims, and then you have approximately 70 days. By the way, that notice may come 3 months after the bankruptcy filing or 2 years, believe it or not, after the bankruptcy filing, because it may take that long for the trustee to foreclose on the property and liquidate the property to make the distribution.
Very good. What's the market like now for mortgage deficiency balances, BHPH and other non-prime areas? I don't know if that can be answered directly.
Yeah. So buy here, pay here. BHPH stands for buy here, pay here. Mortgage deficiency balances, I'm assuming we're referring either to first or second mortgage deficiency balances. As an intermediary or broker, I have handled a handful of mortgage deficiency portfolios over the years, but it's not something that we see frequently. And I'll admit, it's not something that I go out and pursue. Adam, do you have any experience in the mortgage deficiency arena?
Yeah, it's probably the one consumer asset class that we have not purchased is mortgages or second mortgages or mortgage deficiencies. My law firm has had a couple clients that will place those deficiency balances, HELOCs, from time to time, but it's not something we see very frequently either.
Yep. And buy here, pay here. There's certainly a fair number of those that I've seen out in the marketplace. They're not always described as buy here, pay here, but we see a lot of subprime auto deficiency pools out and about. And Adam, I know you and Scott, you too, through American Finance, you both have a lot of experience there.
Yeah, there's a lot of that stuff. And whether you're right, Chris, whether or not people put a buy here, pay here label on it or not, in that space, there's lots of auto charge-offs have been up. And I think likely given what we're seeing in the market, will continue to be a lot of that inventory available.
Yep.
Yeah, agreed.
And again, last couple of questions, and before we run out of time, we're getting close. Any suggestions on how to or whether or not to possibly finance purchases of bad debt?
Yeah, so I know we've got about a minute to go. There are definitely specialty lenders who will finance purchases of bad debt. In my experience, there's usually a long list of due diligence items that they will need, but the short answer is there's absolutely capital out there. Advance rates anywhere between 60 to I've seen as high as 90 or 95%. They're fairly complex, and so if you want to reach out after the fact, I can connect you with a couple of potential sources. And Adam, Scott, Rui, I don't know whether you use any third-party financing, but anything else to add?
I think that was kind of spot on. You got to make sure that you have your stuff together if you're going to do it. Unless you go private, And if you go private money, you can kind of, dictate, I guess, some of the terms. But if you get in with specialty financing, you got to make sure you have all your ducks in a line, because they're gonna, make sure that everything's kind of buttoned up.
Last question, will there be a market for charged off medical debt in light of the recent CFPB announcements?
Great question. Medical debt's a very specialized topic. It's like BK's in my book. We are going to do another webinar on that very subject. I don't know that there's anyone here on our panel today that has. Adam, do you have any experience in the medical arena?
Yeah, quite a bit. I mean, our
Okay.
agency started as an exclusively medical, third-party medical agency in the early 80s, and so we still
Got
do.
that.
Yeah, it's a great question. I mean, there's been a target on medical debt, coming from a lot of places for a long time now. So there are a lot of questions around it. I don't know that we can answer that here in the minute we have remaining. It remains to be seen what that market will look like moving forward.
Yeah, that's great. All right.
As we wrap up, I wanted to first say, where to find DebtLink in Q1. We're going to be at ArmTech coming up in the next few weeks. We're going to have, for those of you that are current DebtLink members, we will have a premier member room. So that's cool. Come by and see us. If you're not, come by and see us anyway. We'll give you a duck. We'll also be at RMAI in February. For those of you, we'll see you at the ARIA again. Come by and say hello. We're going to have be able to demo our platform, answer questions, and show you some things on where DebtLink's going in 2025. So we're pretty excited. And for everybody else listening, just go to detlink.com. It's free. And so that's where we're going to be. Chris?
Yeah, again, I want to thank our panelists today. Rui, for coming in at the last minute. Really appreciate it. Scott, well done. And Adam, always great to share time with you. So thank you to all three of you.